I followed the herd, putting money into traditional IRAs or 401ks invested in the market. Well, how can I get the cost down to 1%? It's understanding the GSP, okay? So let's go back to this example. If I was talking away $500 a month, that's not target premium. You want that to be the maximum premium. $500 a month equals $6,000 a year. The Guideline Single Premium is basically, you times it by 11 years. Don't ask me why. It's just the way the IRS calculated it clear back in 1980 when E.F. Hutton first introduced this. So 11 years times 6,000 would be 66,000. That's the GSP. You take 66,000, the amount of premium that you would pay in the first 11 years, and then you ask the computer to calculate what's the least amount of insurance I can get away with to accommodate a GSP of 66,000. And you'll notice the death benefit is going to be way less than the death benefit if the target premium was 500,000. You're going to end up with twice as much insurance. You're with way more insurance than you need, and that means you're not going to be able to net within 1% of the gross rate of return. You're going to be lucky to earn 7 and net 2 or 3, okay? This is huge, okay? You can't believe how many agents don't understand this. So the GSP is the amount of premium you want to be grandfathered to be able to put into the policy in the first 11 years. Now, most of my clients that are older, they would fund their policy to the max, GSP, not in 11 years. You don't have to take 11 years. You used to be able to throw in that total Guideline Single Premium in one fell swoop. So if I had a client that wanted to reposition 100,000 and they were age 60, they want the least amount of insurance they can get away with. And so they would calculate what's the least amount of insurance for 500,000 in one fell swoop. And back in 1980, the minimum death benefit was about $1,250,000 for a 60-year-old. They could buy way more life insurance than $1,250,000 with a premium of $500,000. That's not the objective. You want the least amount of insurance so that you'll get the best net internal rate of return. Because that $500,000 would double to $1 million. I had many clients that threw in lump sums of $500,000, and it doubled to $1 million within 5 to 7 years. Yep. Now their cash equaled the original death benefit. Now, this is where even later, after the year 2021, when they changed 7702, now a 60-year-old that wants to put in $500,000 can get away with just $1 million of insurance. So you can squeeze down the death benefit down to $1 million. Many of my clients, the $500,000 that they would put in would double to $1 million within, 10, 12 years quite easily. But then TAMRA came around, and TAMRA, the Technical and Miscellaneous Revenue Act, says you can no longer, after June 21st, 1988, put in a lump sum. If you do, it'll be tax deferred, but if you want to start taking out income, it'll be taxable LIFO, last in, first out. Most of my clients want tax-free income. So you want to comply with TAMRA, which means you can only put in maybe 20% a year. $100,000 the first year, and second year, third year, fourth year, fifth year. But if you put in $100,000 the first day of each year, in the fifth year, it's actually 4 years and 1 day into the policy. Now you've got your $500,000 in there. So if that's all you're going to put in, that is the GSP. I don't need to put any more money in if I don't plan on putting any more money in. So the Guideline Single Premium in this case is $500,000, and you're not going to take 11 years to do it. And the minimum death benefit is $1 million. So you calculate the least amount of insurance you can get away with based upon the GSP. The GSP is how much money do you intend to put into this in the first 11 years, even if you're going to get it all in there in 4 years and 1 day. If you don't understand this, you're going to